On August 21, 2025, gold prices took a noticeable dip, catching the attention of investors and analysts around the world. This wasn't just a minor fluctuation. It was a significant move that had many people asking, what's going on with gold? The timing of this drop was especially interesting, as it unfolded during the Asian trading hours, when markets in Tokyo, Hong Kong, and Shanghai are most active. During these hours, trading volumes can be high, and any sudden shift in sentiment can quickly ripple across global markets. The Asian markets are often the first to react to overnight news from the West, and this time, they responded swiftly. But this drop in gold wasn't random or without cause. It was a direct reaction to signals coming from the U.S. Federal Reserve, the central bank whose policies shape the global financial landscape. Gold is more than just a precious metal used in jewelry or stored in vaults. It's a global barometer for economic confidence, reflecting how investors feel about the future of the economy, inflation, and currency values. When gold prices fall, it often signals that investors are feeling more optimistic about other assets like stocks or bonds. It can mean they believe the economy is on solid ground, or that interest rates might rise, making other investments more attractive. The immediate trigger for this move? The release of the Federal Reserve's July meeting notes. These notes gave investors new insights into the Fed's thinking, causing many to rethink their expectations for interest rates and economic policy. The Federal Reserve's influence on interest rates is massive. Its decisions don't just affect the US, they send shockwaves through every major market, from currencies to commodities like gold. Earlier in 2025, gold had been on a tear, reaching new highs as investors sought safety amid uncertainty. But this sudden dip is a powerful reminder that no asset, not even gold, rises forever. Markets are always shifting and confidence can change in an instant. The news from the Fed was enough to prompt a wave of selling as investors quickly adjusted their positions. Headlines flashed across financial news outlets, and trading floors buzzed with activity as gold was sold off. If you want to truly understand what drives gold's price, you have to keep a close eye on the Federal Reserve. Their every word, every signal, can move markets in dramatic ways. The connection between the Fed's decisions and gold's movements is deep and complex, reflecting the constant push and pull between risk and safety in the financial world. This episode is a classic example of how quickly financial news can shift market sentiment, reminding us that in the world of investing, staying informed is everything. The Federal Reserve, often simply called the Fed, is the central bank of the United States. It's not just another government agency. It's the institution at the very heart of America's financial system, with a reach that extends far beyond U.S. borders. The Fed's decisions ripple through the global economy, affecting everything from the price of groceries to the value of your retirement savings. As the world's most influential central bank, the Fed's policies set the tone for financial markets everywhere. When the Fed acts, investors, governments, and businesses across the globe pay close attention, knowing that even a small change can have massive consequences. The Fed's main tool is the federal funds rate, the interest rate at which banks lend to each other overnight. This rate might sound technical, but it's the foundation for all other interest rates in the economy, from mortgages to credit cards to business loans. When the Fed raises rates to fight inflation, borrowing money becomes more expensive for everyone. That means fewer people take out loans, businesses slow down expansion, and overall spending drops. It's a powerful way to cool off an overheating economy. On the flip side, when the Fed lowers rates, borrowing gets cheaper. People are more likely to buy homes, start businesses, or make big purchases. This stimulates economic growth and can help pull the country out of a slowdown. For gold investors, every move the Fed makes is crucial. That's because gold and interest rates often have an inverse relationship. When rates go up, gold tends to lose its shine. When rates fall, gold often glitters. Why? High interest rates make assets like bonds and savings accounts more attractive since they pay out interest. Gold, on the other hand, doesn't pay any interest or dividends. So when rates are high, investors may prefer to park their money elsewhere. This is what economists call opportunity cost. Choosing to invest in gold means missing out on the interest you could earn from other assets. Every investor has to weigh these trade-offs, especially when the Fed is making big moves. That's why the market is obsessed with predicting the Fed's next step. Every speech, every press conference, every economic report is analyzed for clues. Traders and analysts try to get ahead of the curve, hoping to profit from the Fed's next decision. If investors think a rate cut is coming, gold prices usually surge as people look for safe havens. But if the Fed signals that rates will stay high, gold often drops as money flows into interest-bearing assets. Right now, in August 2025, the market is on edge. Shifting expectations about the Fed's next move are pushing gold prices lower, as investors react to every new piece of information. The Fed's influence isn't limited to the US. Its signals can move billions of dollars around the world in just minutes. Currency values, stock markets, and commodities like gold all respond instantly to what the Fed says and does. For anyone investing in gold, understanding this relationship is essential. It's not just about watching gold prices, it's about reading the Fed's signals and anticipating how the market will react. In the end, the guessing game over interest rates is what drives much of gold's wild swings. The Fed is the big player in gold's game, and its every move keeps investors on their toes. The Fed's July meeting minutes revealed most policymakers aren't ready to cut rates yet. Investors had hoped for a September rate cut, but the notes showed a more cautious, hawkish stance. Only a couple of members supported a cut. Most wanted more data, especially on inflation. Ongoing trade tariffs and inflation risks were major concerns. The Fed's priority is keeping inflation in check, even if it means higher rates for longer. This reality check dashed hopes for quick rate cuts and weakened gold's appeal. The market quickly adjusted, and gold prices dipped as a result. The Fed's hawkish minutes caused a sharp shift in market expectations. Before the release, traders were nearly certain of a September rate cut, fueling gold's rally. Afterward, the probability of a cut dropped significantly, triggering a sell-off in gold. Large funds reacted instantly, selling gold as the case for lower rates weakened. The market is a collection of rapid decisions, not a single entity. When new information arrives, sentiment can flip in hours. Now, uncertainty dominates, and investors are reducing risk. For gold, the tailwind of expected rate cuts has turned into a headwind. Everyone's waiting for more clarity from the Fed. Gold's sensitivity to interest rates is all about competition for your investment dollars. Every time you consider where to put your money, you're weighing the potential returns, the risks, and the alternatives. Gold for centuries has been seen as a safe haven, a store of value when markets get rocky or inflation eats away at cash. But in today's world, it's not just about safety, it's about opportunity cost, what you might be missing out on by choosing gold over other investments. Gold doesn't pay interest or dividends. It just sits there. Unlike stocks that can pay you dividends or bonds that offer regular interest, gold's value comes from what people are willing to pay for it. That means when you hold gold, you're hoping its price will rise, but you're not earning anything in the meantime. When rates are low, the opportunity cost of holding gold is minimal. There aren't many attractive alternatives, so gold can shine as a safe, stable choice. Investors don't feel like they're missing out on much by holding gold instead of cash or bonds, but when the Fed raises rates, bonds and savings accounts become much more attractive. Suddenly, you can earn a guaranteed return just by parking your money in a savings account or buying government bonds. These options start to look better compared to gold, which just sits there. Suddenly, holding gold means missing out on guaranteed returns elsewhere. Investors start to question whether it's worth keeping their money in gold when they could be earning steady interest with far less risk. Investors shift to income-producing assets, pushing gold prices down. As more people move their money out of gold and into bonds or savings, the demand for gold drops, and so does its price. The Fed's recent signals suggest high rates could stick around, making gold less appealing. If rates stay high for a long time, gold could struggle to attract investors who want steady, predictable returns. It's a seesaw: higher rates, lower gold; lower rates, higher gold. The relationship is almost like a tug of war, with gold and interest rates pulling in opposite directions. When one goes up, the other tends to go down. This dynamic is why gold investors obsess over every Fed announcement. Even a hint that rates might change can send gold prices swinging as traders try to get ahead of the next big move. The competition between gold and interest-bearing assets is constant. Investors are always comparing the potential returns, the risks, and the safety of each option, trying to find the best place for their money. The Fed's stance can quickly change the investment landscape. A single policy shift can ripple through markets, changing the outlook for gold, bonds, and everything in between. Understanding this helps explain gold's volatility. Its price isn't just about supply and demand, it's about how it stacks up against every other investment out there, especially when interest rates are on the move. It's all about where your money works hardest. Whether you choose gold or something else, knowing how interest rates affect your options can help you make smarter investment decisions. Let's look at the numbers. On August 21, 2025, spot gold fell to $3,339.31 an ounce, down 0.3%. Gold futures for October also dipped, trading at $3,381.62. Other metals felt the pressure too. Platinum dropped 0.2% to $1,337.45, while silver held steady at $37.91. Industrial metals like copper also slipped, reflecting concerns about economic growth. These small percentage moves represent millions in value and signal a broader market adjustment. The Fed's message was clear: higher rates may be here to stay. Commodities across the board are repricing for this new reality. Every price move is a direct response to central bank signals. Despite the dip, gold's long-term outlook remains strong. It's still trading near historic highs thanks to ongoing global uncertainty. Gold's role as a safe haven asset hasn't changed. Economic slowdowns, political instability, and conflicts keep demand for gold alive. Geopolitical risks like the ongoing Russia-Ukraine conflict add to gold's appeal. These factors act as a safety net, preventing gold from falling too far. The market is in a tug-of-war. Higher rates pull gold down, but fear and uncertainty push it up. The Fed's hawkish stance won the latest round, but the story isn't over. Gold's value as a hedge against chaos is as relevant as ever. That's why it's held onto most of its 2025 gains. The fundamental reasons to own gold remain intact. With the Fed's July minutes out, all eyes are on what's next. The Jackson Hole Economics Symposium is this week, with Fed Chair Jerome Powell's speech in the spotlight. His words could reinforce the hawkish message or hint at future rate cuts. Markets will react instantly to his tone and language. Key economic data, like the August PMI and weekly jobless claims, will also shape expectations. Weak data could boost gold, strong data might push it lower. The Fed has made it clear: future moves depend on the data. Every report will be scrutinized for clues. Expect continued volatility as the market digests new information. The next chapter for gold and the economy is about to be written. The recent gold dip is a textbook example of cause and effect in markets. The Fed's cautious message erased hopes for quick rate cuts, triggering a gold sell-off. The Fed's power over global markets is immense. Its every move matters. Gold's value isn't just about rates, it's also about fear and uncertainty. This creates a constant tug-of-war: higher rates versus global anxiety. Sometimes the Fed leads, sometimes gold does. As an investor, your job isn't to predict every move, but to understand the dance. Knowledge of these forces leads to smarter, calmer decisions. That's the real key to long-term financial security. The story of gold and the Fed is far from over.